The changing housing market has home builders scrambling to sell their homes because home buyers are getting sticker shock with the higher mortgage rates, causing people to get worried about the future of home prices. The housing market is shifting. Over the last couple of years after the pandemic, we saw a huge boom in the housing market thanks to the low mortgage rates, but now, because home prices are so high and mortgage rates are skyrocketing, it's making it much less affordable for people to be able to buy a home. Now the question is, how is inflation affecting the housing market? Now you might be thinking, Jaspreet, isn't it obvious? Higher inflation means higher home prices, which means it's more expensive to buy a home. Yeah, that's one part of it, but there's another part of inflation that directly affects the housing market that most people are not talking about, partially because most people don't understand this. There's two factors that really affect housing affordability. Number one is the price of the home, and the second is the cost of your mortgage. Now, if we back up to the beginning part of 2022, January 2022, the median home in America was selling for $429,000. Now, if you put down 20% to buy the home, that would have been $86,000 for your down payment, and then you would finance the rest. Now, assuming that you could get a 30-year fixed rate mortgage for 3%, which was very common in the beginning part of 2022. In fact, you could have got a 30-year fixed rate mortgage for under 3%, but let's be generous here. Assuming you got a 3% mortgage, you would finance the other 80% here, which meant that your monthly payment on this $429,000 home was $1,450 in the beginning part of the year. Now, towards the end of 2022, December 2022, things have changed. For one, home prices have risen. If we look at the CPI data, it shows us that between the early part of 2022 to now, home prices have gone up by around 7%. So if you apply that just over 7% figure here, that means that the same home would cost you $460,000 today. Now again, this is relying on the CPI data, not actual home prices, so I'm being generous here. $460,000 for that same home. Now you're going to put down another 20% here, which means you're going to need more cash for your down payment. However, you're not going to be able to get a 30-year fixed rate mortgage at 3%. You're going to be getting a 30-year fixed rate mortgage for around 7%. That means your monthly payments on this exact same home are going to jump up to $2,470 a month from the beginning part of the year to the end of the year on the exact same home. This is why you're seeing housing demand fall so quickly in the housing market, because home buyers are looking at this saying, wow, not only do I have to pay more money, but I have to borrow more dollars and I have to pay more interest to borrow those dollars, so your costs are significantly higher today than they were just 9, 10, 11, 12 months ago. But this is where understanding how inflation affects the housing market will help you get a better understanding of the general economy when it comes to the housing market. Because when people talk about housing market inflation, the main thing they're talking about is this. But what about this? How do interest rates get affected by inflation? Because interest rates are directly affected by inflation, and this is because of something called the bond market. Let me ask you a question which I think will help you understand how it works. If you had $1,000 to invest, which of these two are going to be a safer investment? Option number one, which is to take this $1,000 and you put it into strong, stable companies on the stock market. Or option number two, you take this $1,000 and you invest this money into your broke cousin Bunty, who keeps begging you and asking you for more money. Which one? Well, this one, the stock market, is going to be a safer investment, which means if you were to invest this $1,000 into your broke cousin Bunty, you better hope that he's going to promise you, or at least expect, to give you much higher returns than the returns you would get in the stock market. If your broke cousin Bunty is offering you a 2% return on your money, well, you'd be better off taking that cash and putting it into the stock market. Every investor is making these types of decisions. They're looking at their different investments and they're weighing the risks and the reward. If it has a higher risk, you would expect a higher reward. This also applies to bond investors. A bond investor is somebody who is loaning their money. For example, you can loan your money to the government. This is called a treasury bond. You can also loan your money into the housing market, into housing market loans. This is called a mortgage-backed security. Now, you're not directly giving your money for a loan, but you're investing into the housing market through the mortgage market by buying mortgage-backed securities. Well, which one would be a safer investment in theory? loaning your money into the mortgage market or loaning your money to the United States government. Now, I know there's a lot of controversy here, but every economist, traditional economist, will tell you that it's safer if you invest your money into the United States government because the United States government has never defaulted and they are guaranteed to give you your money back, partially because they have access to a money printer, so they can always just print more money. So the United States government is supposed to be a safer investment, meaning you should get a lower return from loaning your money to the United States government than by loaning your money into mortgage-backed securities into the mortgage market, which means when people are worried about inflation, that means they're worried about the United States dollar. When people are worried about the United States dollar, that affects the bond market. Which bond market? The Treasury bond market. Because when people are worried about inflation, they're worried about the health of the dollar, so then they're selling Treasury bonds. When you sell Treasury bonds, now the government has to incentivize you to loan money to the government, because now they're not getting as many loans as they were getting before. How does the government incentivize you to loan them money? Well, they got to give you a higher interest rate, because now they have to incentivize you with a higher return to make up for the higher risk. Because again, why are people worried? They're worried about inflation. Now, to make up for the higher risk, the government has to give you a higher return. Risk versus return. They give you this higher return through a higher interest rate. So higher inflation means higher worries, means higher returns on Treasury bonds. When the returns on Treasury bonds go up, well, that means the returns on mortgage-backed securities has to go up even higher, which means that the interest rates that then banks have to loan out to you are also higher. This is why inflation affects mortgage rates, because for one, the Federal Reserve Bank is working to raise interest rates to fight inflation, which is the first factor that affects mortgage rates. But then the second factor which affects mortgage rates is what the bond market is doing. Because when bond yields, bond interest rates are rising, that affects mortgage rates. Because when Treasury yields, loans to the government, those interest rates are rising, that indirectly also affects mortgage rates, because our mortgage rates have to be higher. Because it's riskier to loan your money to mortgage-backed securities, it's riskier to put your money into a mortgage than it is to loan your money to the government. By the way, if you like this type of financial education and you like to stay up to date on what's happening in the housing market, the stock market, crypto, the global economy, and our own economy, then you should join something like Market Briefs. Market Briefs is my free financial newsletter that I created where my team is every day breaking down what's happening in the financial markets. That way you can be more aware as an investor of what's happening in the markets so you can make smarter decisions with your money. Market Briefs is completely free. So if you haven't joined Market Briefs yet, I'll put the link to how you can join down in the description below. But this is where, as you now start to look forward into 2023, you can understand the different factors that are going to affect housing prices and mortgage rates. What's going to affect housing prices? Supply and demand. If supply increases, home prices would have downward pressure. If demand falls even further, well, that's also going to push home prices downwards. Higher mortgage rates make demand go away, which also pushes home prices downward. So home prices have downward pressure because we have builders working to build some homes, but even more than that, you have demand falling because mortgage rates are rising. Now, why are mortgage rates rising? Well, two factors. First is the Federal Reserve Bank. Second is inflation. Now, on the Federal Reserve Bank side, just recently in December, the Federal Reserve Bank raised interest rates again by 50 basis points, 0.5%. So every time the Federal Reserve Bank raises interest rates, that has upward pressure on mortgage rates, which has downward pressure on home prices, because now this makes buying a home less affordable. In addition to that, we still have high inflation. Now, inflation has fallen off of its highs, but inflation is still very high. As of December, CPI is still above 7%. This is still closer to our highs than it is to our target inflation. So if we continue to see high inflation, and if inflation were to rise even more, even if the Fed stopped raising interest rates, that's going to have an upward pressure on mortgage prices, because higher inflation means more worries about Treasury bonds, means higher yields for Treasury bonds, meaning higher interest rates for mortgage rates as well. This is where understanding all the different economic factors comes into play, because all these different pieces then come together. Now, mortgage rates and the housing market is one of the most sensitive factors to interest rates, but higher interest rates affect really every aspect of our economy. It just affects home prices immediately, because when you raise interest rates, you raise mortgage rates, and that makes it more expensive for you to go out and buy a home, and it makes it more difficult for you to refinance a home. But this is where you want to be educated not panicking, not worrying, but educated. That way you can make smarter decisions with your money, because it is your duty to be financially educated, not only so you can take care of yourself, but so you can take care of your family and your community by understanding the way that money works. Now, when people are talking about or worried about a potential housing market crash because home prices and mortgage rates have gone up, that's only the first piece of the puzzle. So let's start by talking about that. In 2020, the median home in America was selling for around $329,000, and if you put down 10%, that would mean that you're borrowing $296,000. And back then, you